You are listening to CEO Perspectives, a podcast by the Conference Board.
Welcome to this episode of CEO Perspectives, a signature series by the Conference Board. Each week, CEO Perspectives will do a different conversation with thought leaders dealing with the issues of our time. We'll take objective, nonpartisan looks at a range of timely topics that matter most to business leaders. To help make sense of these topics, we'll sit down and do what we do best at the Conference Board, provide trusted insights for what's ahead. I'm Steve Odland, the CEO of the Conference Board and the host of this series. And today we're talking about the Conference Board's latest economic indicators. The Consumer Confidence Index just came out, which gives us an inside look at the state of the U.S. economy. And we'll also talk about what CEOs are thinking and what the predictions are for the global economy that's ahead. Joining me today is Lynn Franco, the director of the Indicators Program at the Conference Board. Welcome, Lynn.
Good to be here, Steve.
So, Lynn, brand new consumer confidence data. What does it say?
Well, we saw an uptick in consumer confidence in August. However, we've just sort of recouped the losses that we saw in June and July. So a little bit of sort of sideways movement. I think the real important takeaway here is the expectations component, which did improve, but it's been below 80, which is sort of the traditional line in the sand for a recession for several months now. So recession risks, despite this improvement, do persist.
So basically, there are two components, you're saying, to the Consumer Confidence Index. One is present situations, or how people are feeling now, versus how they think things will play out over the next 6 months. Is that right?
Absolutely. And the present situation takes a look at both business conditions and employment. And we know that's really been supported by very strong job market. But we are seeing signs of softening there as well. And expectations, which is sort of the 6-month outlook for business conditions, employment, and income, has been relatively weak for several months now and sort of flashing red in terms of a recession signal.
And so that's been the case for the past few months. So in this past month, now in this survey, how is the current situation different, and how is the expectations different?
Well, we saw an improvement in the present situation, right? And I think, again, that's really being supported by job growth. And we've seen very strong numbers over the last few months. So that's the reason we've saw a bump up in the present situation assessment. In terms of consumers' expectations, we also saw a bit of an improvement. It's at 75.1 now, but again, it's still sort of below 80, which tends to be sort of recession territory.
Yeah. Now, you're not saying that necessarily you're not relying on the consumers to predict a recession or not. We're asking them how they feel. And typically when they feel this way, or when they're responding this way, it means that we're in recession territory. Is that a fair interpretation?
It means we're either in one or heading towards one. So I think, we're sort of looking ahead for the next 6 months, and obviously consumers are not giving a thumbs up on the direction of the economy.
Now, what are they saying about inflation? Because that seems to be the crux of everything right now.
Absolutely. And we've seen now several months of very high inflation expectations and a little bit of a tapering off in July and August. But overall, inflation expectations remained very elevated. And in particular, consumers have cited concerns about gas prices and food prices. So maybe some of this easing that we've seen has coincided with prices coming down at the gas pump.
Well, and that's true. And the prices have been coming down nationally for the past couple of months, even though food prices continue to rise. But I think we saw flat inflation month to month between July and August. So essentially, maybe the consumers are saying, hey, maybe this is okay now because it didn't go up.
Right, exactly. So they're sort of readjusting, I think, their expectations. But by historical standards, it's very elevated. So, inflation continues to be sort of one of the headwinds that consumer confidence is going to face.
Yeah, and we're still experiencing levels that are 40-year highs. But this is a little different because this inflation is really hitting basic foodstuffs and gas, which are two components of spending that hit every consumer, regardless of income. And unfortunately, that means it hits the poorest consumers the most because that's a higher proportion of their total spend, right?
Absolutely. And, we see sort of a tale of two consumers when you take a look at consumer confidence by income groups. And those with more moderate earnings are obviously much less confident than those at the higher end. So the impact on the budget is much more significant.
And what do you see about intent then to spend on, any specific kinds of goods? Typically we look at housing and, appliances and those automobiles and those kinds of things. What are they telling us?
Well, we did see a bit of a rebound this month, compared to the pullback that we had seen in July. But if we just take a little bit step further back in time here and begin where we were sort of at the start of the year, we've seen sort of a general downward trend. And a lot of that has to do with A, inflation, and B, interest rate hikes, especially in terms of housing, where we've seen mortgage rates, increase, and that's had an impact. I think as we look ahead, we're going to continue to face interest rate hikes. So this is going to challenge durable spending, and also the shift that we've seen, right, where consumers have sort of gone into a pre-pandemic type of spending now, where they tend to spend a bit more on services. So we're still experiencing that shift, because how many refrigerators do you really need, right? So that shift, I think, is going to continue, and I think it's going to continue to see sort of a diminishing expectations or purchasing expectations for these durable items.
The supply chain issues that started with the COVID crisis and the shutdowns in China and their zero COVID policy have continued to ripple through. So you still see shortages of automobiles and used cars, and so it seems like demand is still up as these shortages persist. But what you're saying is that consumers are starting to say that their intent to purchase is lower. Is that a fair read?
Yes, it is.
Yeah. Okay. All right. So then you have to juxtapose what the consumers are telling us versus what the CEOs are saying. Not that CEOs are anything special, but they're representatives of the business community, and therefore, what's going to happen with all of that spending. Of course, the consumer is a huge part of GDP, but the decisions that CEOs and companies make impact the GDP as well. So what are you hearing from CEOs?
Well, it's definitely not good news either. Our Q3 survey, we saw CEO confidence plunge even further, as CEOs are confronted with, high inflation, rapidly tightening monetary policy, and just ongoing geopolitical uncertainty. So that measure is now down to 34 from 42 in Q2. And it's at levels that we've seen sort of during the COVID-19 pandemic, and also levels that are associated with a contraction. So we've got, pretty sort of depressed readings in terms of CEO confidence.
And so why are CEOs so dour?
Well, there's a variety of reasons. And I think the number one in particular is that an overwhelming majority of them, more than 4 out of 5, said they're preparing for a shallow recession, for brief and shallow, but that they expect this sort of slowdown over the next 12 to 18 months. So I think they're sort of getting in position and positioning their companies to deal with a potential recession over the coming months.
Now, part of what they're saying is that it's because of the actions of the Fed trying to tame inflation, right?
Absolutely, coupled with supply, constraint shortages. We've got also wage inflation that's still very persistent, and doesn't show signs of easing yet. So there's several challenges that I think are a bit sort of longer term issues.
Now, even if they do cut back, typically what the Fed worries about is, as they're trying to bring inflation down by increasing the discount rate, they worry that that's going to impact jobs. But in this case, we still have over 10 million job openings and really a labor shortage. We have, historic lows in the unemployment rate. So it feels like they have a ways to go here without damaging, the labor market. Is that the way you read it?
Absolutely. In fact, I think it's very interesting that you bring up this point because they don't seem to sort of be experiencing the same recessionary conditions that we've seen, during other contractions, right? So now we have seen a bit of easing in hiring tensions, but it still remains, rather robust. There's a little bit of easing in terms of talent shortages, but again, it's still relatively elevated. And on the flip side, CapEx plans still remain rather robust. So it's sort of a bit of a different type of recession and reactions that we're seeing this time around.
Yeah, and if I was a CEO looking at this situation and I have all these job openings that I can't fill, I think the first jobs to eliminate are those that aren't filled. In other words, you eliminate the openings. And so, if that was done perfectly, which of course, nothing ever happens quite perfectly, but you could eliminate 10 million jobs without affecting any person, just by eliminating the openings. So it feels like, this could be relatively shallow. And that's the reason I think probably why CEOs are saying that it's going to be short and it's going to be shallow, but it's going to be a recession.
Absolutely. And it'll be interesting to see when we field our next CEO confidence survey if any of these attitudes have shifted.
Yeah, the only wild card here is that where is the discount rate going to go? How high will interest rates have to be raised, because that does impact the cost of borrowing. You mentioned mortgage rates, so it's borrowing for the consumer, of course, but also for business. So as businesses are planning their capital expenditures, you have to put a cost of capital or a cost of debt in there, and that's the one kind of wild card in there, because if you get upside down on that, you can have your investments really not pay out. So that's another thing that CEOs are saying here. So a lot of uncertainty out there.
Absolutely. Absolutely. There's a lot of uncertainty. We've seen some sort of moderate shifting since Q2. And overall, I think both CEOs and even consumers to an extent remain rather pessimistic and rather cautious about the short-term outlook.
We're talking about the latest consumer confidence and CEO confidence results. Next, we're going to talk about the global economic forecasts. We'll take a short break and be right back.
As you and your company monitor the latest wave of shocks that have battered the U.S. economy, the award-winning forecast team at the Conference Board now predicts a U.S. recession by the end of 2022. This recession will further compound the crises that have recently upended expectations, from a deadly pandemic to a war in Ukraine and the highest inflation rate in decades. Yet, unprecedented crises also present unforeseen opportunities if you have a trusted, proven navigator by your side. With that in mind, the Conference Board continues its long-standing tradition of providing timely and relevant content on a daily basis to help guide the business community through the economic storm. These trusted insights are being gathered on our website and are available to help your company master the challenges ahead. Chart a course for the future, which will allow your business to emerge stronger on the other side by visiting our free economic hub entitled Navigating the Economic Storm, your indispensable guide through the global recession, located at www.conference-board.org/topics/recession.
Welcome back to CEO Perspectives. I'm your host, Steve Odland, the CEO of the Conference Board, and I'm joined today by Lynn Franco, the head of the Indicators program at the Conference Board. So Lynn, before the break, we were talking about CEO and consumer confidence. Now the question is, what are our forecasts about where things are going? Let's talk about the U.S. first. What does the Conference Board project will happen to U.S. GDP?
Well, Steve, we're expecting a recession probably later this year in Q4 into Q1 of 2023. We expect it to be, rather shallow and limited somewhat, at least to the time being, to the U.S. And primarily this is driven by, the tightening cycle that we've seen, and we've heard from the Fed that that's going to continue. So we think that, the potential is obviously greatly increasing for a shallow and brief recession.
Now, we've had 2 quarters consecutively, the first and the second quarter, with GDP declines. But, the official arbiters of the recession, calling a recession, are saying that we're not in a recession, that's just one component. Talk about that, because I'm not sure everybody understands, what goes into calling a recession.
Well, there's a variety of factors, and I think maybe the one that's probably most glaring at the moment is employment, right? So as we've seen, this is probably a job-full recession, as people have been referring to it. We've had very strong employment growth. We've seen some cooling there as well, but we're not sort of seeing, the declines in employment and the rising unemployment rate that's typically associated with recession. So I think, we're sort of waiting to see what happens in terms of the labor market, but that's one factor that's not reacting sort of per usual as it does.
Right. So, you typically think of recessions as being painful for people, let's just, in general. But as of this point, it's been the inflation that's been painful with food and gas prices. But the other pain of the recession, which are jobs and the broader impact, has not happened. So even if we go into a shallow recession, will there be pain for consumers?
There may be some, but could be very minimal, right? Because again, we've got still robust growth in terms of employment. I think that's expected to cool somewhat, and we see that in our CEO confidence and a little bit in sort of consumer confidence expectations as well. But it doesn't appear to be as painful as, let's say, we experienced during, the great financial crisis or during the COVID-19 pandemic. So this one has a set of different unique features.
Yeah, and Fed Chair Powell at the summer retreat, I'm paraphrasing, but said essentially the number one goal here is to get inflation down close to 2%, which is their goal. And if there are other impacts of that, meaning if GDP goes negative or whatever, that's acceptable because we need to get the inflation down. So this could actually be an interesting situation where we have a recession that eliminates the pain of inflation without inflicting the pain of anything else.
Correct. Interesting times that definitely bear watching, but this is shaping up at least to be somewhat of a different recession than we've seen over the recent past.
Okay, so what are the downside risks to that sort of base case of a shallow, couple of quarter recession?
Well, you've mentioned quite a few already. So, higher inflation is a potential downside risks. A deep housing recession, we've already begun to see some sort of cooling in the housing market, even though prices remain elevated. We've seen mortgage rates, ticking up. Delayed government spending on infrastructure could be sort of another of the downside risks. And then spillover from some of our regional partners, whether it's from Europe or from China, could also be sort of headwinds that the U.S. May face over the next couple of months.
Yeah, very interesting. So, and this is a really important point. I mean, as we've felt and learned, real time, the U.S. economy is interacted and interwoven with the global economy, and we've seen that with the supply chain issues. Talk about some of the other regions of the world. Where are their economies going? Is there going to be a global recession, or is it going to be limited to certain areas?
Well, at the moment, we're not forecasting a global recession, but certainly the risks remain high. So we're definitely monitoring that. Now, where we do anticipate a recession outside of the US is in the UK and the Euro area. And we're also downgrading our expectations for China as well. So these are some areas where we're seeing significant sort of slowdowns in growth with the potential to tip into a recession.
Okay, so let's take the euro area first. How much of that the prediction for a recession there is driven by just simply the inflationary environment, and how much is driven by the Russia-Ukraine war?
Well, those are the two major factors that are really impacting growth. And we're seeing, extreme weaknesses in some of the large economies, in particular, UK and Germany. And as you mentioned, a lot of it is sort of the worsening conditions in the Ukraine and the effects on commodity prices and also supply chain issues. We've seen this surge in natural gas prices, and that's having a tremendously negative impact. And then also inflation and monetary tightening. So it's sort of a twofold challenge that Europe is facing at the moment.
Yeah, and we've heard a lot about potential shortages of food and energy from Ukraine and Russia, but those exports from that region tended to go to Africa and some of the Asian developing nations, some of the poor nations, and so even though there could be some disastrous results, those nations don't produce a lot of GDP, in the global total output, and so hence, while it could really have some localized effects, and there could be food shortages, for example, the effect on GDP is not that huge, and I think that's sort of the flip side of what you're saying, right?
Correct.
Yeah. So then let's flip to China. You mentioned China. China is, one of the largest economies in the world. Obviously, they've taken a different view of COVID. They continue to shut down whole areas of their economy, the ports and so forth. Recently, Shanghai was shut down, one of the largest cities in the world. That's their strategy to deal with COVID, but it does have a ripple effect across not only their economy, but the rest of the world.
Well, absolutely. And we see the ripple effects every single time we have one of sort of these shutdowns take place. And it's also really impacting China's economy itself, as you just mentioned. And then on top of that, you sort of overlay sort of a weakening consumer in China, right? So that we've seen spending somewhat on a bit of a decline. And then a bit of the housing market, right, which is sort of undergoing a crisis of its own. So China is also facing several challenges to growth.
Yeah, and you think about China being a low single-digit grower, which looks more like a developed nation, the Western European numbers or the US, Canada kinds of numbers, but they've been a developing economy for a long time. And so that delta from what, 6-7% growth down to 1 or 2% growth is a huge change for them, even though the numbers remain positive.
Well, absolutely. And, we expect China to grow by 3.7% this year, which for other economies might look like very robust growth. For them, it's definitely a bit of a slowdown. And that's sort of then when we adjusted ourselves, we expect that growth actually to trickle down to 2%. So China's growth potential is really slowing over these past few quarters, and we expect that to continue.
And of course, there's been a lot of news about the saber rattling across the Taiwan Straits and, that whole situation. What impact could we're not predicting it, but a Taiwan invasion, what impact could that have either on China's GDP or the region?
I think both on China and the region, we'd see negative repercussions, right? So it's going to shave off a few extra tenths of a percent, if not more. Then you have supply chain disruptions, geopolitical uncertainty. So just a lot of factors that are not conducive to economic growth.
Exactly. So now we've talked about the consumer confidence, the CEO confidence. We've talked about your forecast for GDP. The other, whole series of indicators that you do are the leading economic indicators, which you do by country. Anything in those data that you want to talk about that stand out?
Sure, and not positive news coming from our LEIs either. So we take a look at our U.S. indicator, Germany, UK, and the Euro area, just to sort of call out a few from the portfolio. All of those have been downshifting over the last several months, and all of them seem to be headed towards contraction territory. So we're getting a lot of sort of red signals from particular economies. If we take a look at sort of Japan, South Korea, Mexico, and Brazil, these economies continue to struggle with high inflation, uncertainty in the energy markets, global trade disruptions. And so we're forecasting slowdowns and additional sort of headwinds as this sort of high inflation, supply chain interrupted environment continues.
So if we were to wrap all this up, I think what all of our indicators are saying is that regardless of whether you call it an official recession, GDP in most of the developing markets is receding. So GDPs are receding, and that the consumer, the confidence is going down, spending probably will follow, inflation continues to be high, central banks are taking action, which should help bring inflation down, but can also bring growth down. And so hence, we're heading towards a slower period of time, but hopefully one that is as soft as possible, without causing a lot of pain for consumers around the world. Is that a fair summary of what we're seeing?
I think that's a perfect summary of what we're seeing and what we're expecting.
Good. Any other comments or anything else in the data that you'd like to share?
I think we've covered just about everything. I think the important thing is to keep an eye on what happens over the next several months, in particular with consumer confidence, right? We had a 1 month bump up, but 1 month does not a trend make. So it's important to continue to look at that and to look at sort of the particular sub-indices, right? The present situation versus the expectations for any signals. We're going to be releasing our next CEO confidence in October. So I think it's important to sort of see where CEOs are as things have changed quite dramatically since our last survey, and continue to monitor our LEIs. I think we've added sort of some charts which are particularly interesting there that sort of can give us pre-recession warnings. So we'll just see how many of these economies begin flashing over the next several months.
And if any of our listeners want to learn more, you can access it at our website, tcb.org. Lynn Franco, thanks so much for joining us today.
Thank you, Steve.
And thanks to all of you for listening in to CEO Perspectives. Every week, I'll be joined by a prominent thought leader to provide insights on the issues of our time. We'll cover leading topics in geopolitics, economics, public policy, ESG, human capital, and more. Please share CEO Perspectives with your colleagues, with your friends, with your children, with your grandchildren. Everybody wants to hear it. I'm Steve Odland, and this series has been brought to you by the Conference Board.
You've been listening to a podcast from the Conference Board, the indispensable ally that has helped businesses through war, recession, and economic transformation for over 100 years. As recent unexpected economic challenges persist, you can chart a course for the future, which will allow your business to emerge stronger on the other side. Just visit our free economic hub entitled Navigating the Economic Storm, your indispensable guide through the global recession, located at www.conference-board.org/topics/recession.